How to Increase Your Credit Score by 100 Points in 6 Months by Silverline Insurance. Week 5. Credit Score Myths and Truths. Here's what you will learn in this course. Debunking common credit score myths and understanding the truth about credit inquiries and their impact on credit scores. Hi, I'm Jason, and welcome to Week 5 of our educational course on improving your credit score by 100 points or more. We're a little over halfway through our journey, and so far we've covered topics like credit scores and reports, budgeting, debt management, credit utilization, credit history, and managing different types of credit. This week, we'll debunk some common credit score myths, explore the truth about credit inquiries. Enjoy! Debunking common credit score myths. Credit score myths can be misleading or just downright complicated and cause confusion. Let's debunk some of the most common myths. Myth 1. Closing credit accounts will improve your credit score. Truth. Closing credit accounts can actually hurt your credit score. When you close an account, it can reduce your available credit, which may increase your credit utilization ratio and negatively impact your score. Additionally, closing old accounts can shorten your credit history, another factor that affects your score. I made this mistake a few years ago, and now my wife makes fun of me all the time because her credit is now better than mine. What's the difference between her credit and mine? She has the same credit card since college. So her credit history is longer than mine, and as a result has a better score by at least 40 points. Everything else is the same. That's what you should be going for to increase your credit score. Pro tip: do your best to make your first card one with no annual fee. Why, you ask? In case you stop using it for some reason later in life. It's hard to justify paying an annual fee for a credit card you don't use just to keep your credit score high. So guarantee a better outcome for yourself in the future by avoiding a card with an annual fee today. Myth 2. Checking your credit score hurts your credit score. Truth. Checking your credit score is considered a soft inquiry and does not impact your credit score. You're encouraged to monitor your credit score and report regularly to stay informed about your credit health. It's important to note that hard inquiries, such as applying for new credit, can have a temporary negative impact on your score. If a company wants to run your credit, ask, is this a hard inquiry or a soft inquiry? To help you determine your next step. Pro tip: I check my own credit on Credit Karma every day, without any negative effect. I encourage you to check your credit before and after you make changes to your credit profile. I bet you will get a thrill to see your credit going up as a result of all the changes you have been making. Myth 3. Using debit or cash to make all your payments doesn't help build credit. This is a good myth to discuss because it's true only in certain instances, making it a confusing topic for most. Here is the truth about it. 1. Imagine you never had a credit card or loan under your name. Basically, you went from adolescence to adulthood always using cash or debit card. In this case, continuing to use cash and your debit card isn't going to do much for building your credit profile. The myth is true. 2. Now imagine you already have an established credit history with a few credit cards and/or loans under your belt, and you are looking to make a big purchase, like a new car, home, or new insurance policy. By switching to a cash/debit card system for new purchases and paying down your existing debt for at least 3 months before making a purchase, you can significantly enhance your appeal to lenders or insurers. This demonstrates that your financial house is in order, you have no need for additional credit, and you can successfully manage a variety of credit. In this scenario, using cash or debit cards will help you significantly increase your credit score. Myth busted. This is like detoxing your credit profile and showing the best version of yourself before making those large purchases. Myth 4. There's a common misconception that each person has only one credit score. Truth. There are several credit bureaus that calculate credit scores, and they might use different scoring models and have access to different sets of data. The main bureaus are Equifax, Experian, and TransUnion. As a result, you can have multiple credit scores. Sometimes these companies have wildly different scores. Be sure that any incorrect information on any of them is corrected. Once you are satisfied there are no errors on your credit reports with any of the credit reporting bureaus, Then you can determine how a lender or insurance company might view the three different scores. Lenders, banks will generally look at all three, then choose the lower of the three and assign that as your score. Keep this in mind and pick a target credit score that is higher than what you actually need to offset this issue. Myth 5. Some people believe that once they have paid off a debt in collections, it will be immediately removed from their credit report. Truth. Negative records such as collections, bankruptcies, and late payments can remain on your credit report for up to 7 years, although their impact diminishes over time. Basically, your credit history is a permanent record of how you have managed your financial life for the past 7 years. Past mistakes may not disappear, but you can still definitely increase your credit score by 100 points or more the longer you follow this program. And the further away the mistakes get from your present-day situation, the better your score will be. Now, the opposite is also true. The longer you leave bad debt or derogatory items on your profile, the worse your credit score becomes. Myth 6. It's a common misconception that carrying a balance on your credit card from month to month can improve your credit score. Truth. I have heard this over and over in my career and finally happy to share this with everyone in my community. Carrying a balance is not necessary to improve your credit score and may actually hurt your score if you are utilizing more than 30% of your credit. It is better to pay off your statement balance in full every month to avoid interest charges and maintain a low credit utilization. Myth finally busted. Myth 7. Some people believe that earning a higher income will directly increase their credit score. Truth. While income can influence your ability to borrow and repay loans, it is not a factor in calculating your credit score. Payment history, credit utilization, length of credit history, types of credit in use, and new credit are the factors considered. This is a great topic because in real life, different people will have different results when it comes to this as a result of how these variables work together. Let's take a closer look. There are two variables at play here: interest versus credit limit. Your credit score determines your eligibility for credit and, if approved, will ultimately be expressed as an interest rate. Your credit limit, or how much you can borrow, is directly influenced by your income. The more you earn, the more you can theoretically borrow, because your ability to repay should increase as your income increases. It is possible for someone with a higher income to have a higher credit limit, but if their credit score is low, they may have to pay it back at a higher interest rate. Compared to a person with a lower income but great credit, the overall credit limit may be lower, but so will the interest rate. Does that make sense? I personally believe the banks have done a great job of figuring out the correct balance of credit limit to extend to each person based on their income. This literally prevents you from spending so much to the point where it becomes impossible to pay back. So embrace your credit limit. It's for your own financial health. If you are unhappy with it, but follow the recommendations in this course, it will improve over time and hopefully you will never find yourself in financial trouble as a result. Myth 8. Some renters assume that paying rent on time will help build a positive credit history. Truth. Regular rent payments are typically not reported to credit bureaus, so they usually do not directly impact your credit score. However, some rent reporting services can help renters get credit for on-time payments. This requires a subscription, but may be worth it for someone who wants to build a credit profile with past payments. If you go this route, please let us know how it worked out. I've never done this and wonder how it helped you. Myth 9. I want to buy that car on loan so that I can build my credit profile. Truth. Just like previous examples, the correct answer to this myth largely depends on where you are in life. If you recall, an auto loan only represents 10% of your credit score. If you're seeking an auto loan but have no credit history, you might want to explore other, less expensive ways to build your credit. Without a credit history, securing an auto loan can result in significantly higher interest rates. For instance, while someone with a great credit history might get an offer of a 7% interest rate on a new car loan, a person without that history could face rates as high as 16% for a used car. Therefore, consider alternative methods to establish credit that might be more effective and less costly. Here is an example of what we mean. Over a 6-year period, a person with poor or non-existent credit may receive a loan with a 16% interest rate you will pay $17,697.09 in interest over the life of the loan. But if you had good credit, defined as a FICO score of 700 or better, you would only pay $7,167.15 in interest over the same period, assuming all other factors of the loan were the same. This represents a savings of about $10,000. Pro tip: always aim to put the most amount of cash down when buying things on credit to reduce the amount of interest you will pay. In this example, it is more advantageous to you to put a 20% down payment. Higher amounts of down payment may unlock even lower interest rates for you, since this significantly reduces the risk associated with your loan. Talk to your lending professional about this. Still wondering if you should buy that car on credit to boost your credit score? The decision is yours to make. Our hope is to have provided enough information to help you make the best decision for you and your family. Myth 10. Some believe that it's fine to use up all their available credit as long as they pay it off. Truth: maxing out your credit card can significantly affect your credit utilization rate, a major factor in credit scores, even if you pay it off in full by the due date. Pro tip: if you max out your credit card and want to avoid the negative effect of this, all you have to do is pay your balance down before the statement closes. Here is how it works. There is nothing wrong with maxing out your card. This is not the thing that hurts your credit score. It's when the credit card statement closes and this information is reported to the credit bureaus. That's when you lose massive amount of points on your credit for overutilization. Just to be clear, in order for this tip to work, you need to pay down the balance of the card before the statement closes. In other words, pay down at least 70% of the monthly balance, then the other 30% can be paid when the credit card company sends you the bill. In comparison to the credit card company reporting a max out of your card, this is the best alternative to prevent your credit score from losing a lot of points. By the way, it's even okay to make weekly payments to the credit card company as a way to bring down the balance before the statement closes to avoid being reported to the credit bureaus as having maxed out your credit card. Do you see why it works? If you are still unsure, visit our Facebook page for more information and support. 2. Understanding the truth about credit inquiries and their impact on credit scores. Credit inquiries fall into two categories: hard inquiries and soft inquiries. Understanding the difference between the two is crucial to maintaining a healthy credit score. Hard inquiries. A hard inquiry occurs when a lender or creditor checks your credit as part of their decision-making process when you apply for credit, such as a loan, credit card, or mortgage. Hard inquiries can have a short-term negative impact on your credit score, typically lowering it by a few points for up to 12 months. Multiple hard inquiries in a short period can be seen as a sign of financial distress and may further decrease your score. However, some scoring models group multiple inquiries for the same type of credit, like an auto loan or mortgage, within a specific time frame as a single inquiry to account for rate shopping. Pro tip: when shopping for a car or a mortgage, never let anyone run your credit until you are ready to make a purchase. And even then, we recommend you inform the credit department of your lowest credit score on Credit Karma and request for estimated terms based on the credit you are reporting. If the estimated terms are acceptable to you, authorize your credit to be run and be sure to demand better terms now that they see you are a great credit risk. Why should you prevent lenders from running your credit? Many lenders for mortgages or autos work with multiple banks. Every bank will want to run your credit, a hard credit inquiry, and every time this happens, you lower your credit score. Imagine you go to 2 dealers, each with 3 banks. You apply for a loan at each trying to get the best deal for yourself, and then you end up with a total of 6 hard credit inquiries, each lowering your score by about 5 points. Instead, try to get an estimate of what your terms would look like based on your reported credit score. It's not a perfect science, I know, but is the alternative better? If the dealer denies your request, look for terms on the internet, get your own loan, and buy the car outright. Soft inquiries: when you check your own credit score or when a company checks your credit for a pre-approved offer or account review. These type of inquiries do not affect your credit score and are not visible to potential lenders or creditors on your credit report. Thankfully, credit inquiries for insurance falls into the soft category. You can apply for insurance confidently knowing that the application process has no effect on your credit score. In case you were wondering, the reason this is so is because the insurance company isn't lending you money. Week 5 Action Steps. After completing Week 5 of our credit score improvement course, take the following 3 important action steps to make the most of what you've learned. 1. Dispel credit score myths. Keep the truths behind common credit score myths in mind and avoid falling for misconceptions. Share this knowledge with others to help prevent the spread of misinformation about credit scores, which could hinder their credit improvement journey. 2. Monitor your credit inquiries. Be aware of the difference between hard and soft inquiries and limit the number of hard inquiries on your credit report by only applying for new credit when necessary. When rate shopping for loans, do so within a short time frame to minimize the impact of multiple inquiries on your credit score. By actively sharing the lessons with family and friends from Week 5, you will further your understanding of these credit principles while accelerating your journey to financial success. At Silverline Insurance, we dream of transforming 1 million credit scores, enhancing each individual's life and uplifting our community, one person at a time. Tell your friends and family to join us in making this dream a reality on our journey to success. Ask them to visit our website to enroll today.